All right, folks. So what I want to do to start class today is try to quickly go through a few practice problems with you guys. I know we're sort of rushing through this material. I wish I had a little bit more time to cover it all as efficiently as I want. So let's do that and then try to, as quickly as we can, finish up the material in this section on bond markets and interest rate determination. That way I can at least get somewhat into the last topic of this course, which is on something called the term structure of interest rates. So just as a reminder, I guess, we've got class this week, so today and then on Wednesday. I'm hoping to have finished the material by then. I believe next week, the week after Thanksgiving, there will be no classes, but I will give you guys your fourth and final lab assignment that you can just complete on your own and submit to me electronically. And then your final exam is going to be online as well, right? So for that, I'll just give you more details on that, but that's going to have to be remote. Okay, let's go over a couple of the. Let's see how many of these we can do here in the first part of class today. The first few are about bond pricing and present value. So if the interest rate is 10%, what is the present value of a security that pays $1,100 next year, $1,210 the year after, and then $1,331 the year after that? If I wanted to write down a formula that would compute the present value of an asset that pays those payments over the next 3 years, given a 10% interest rate, what would that formula look like? It's more important to me that you understand the formula rather than to be able to compute the exact value. Come on, folks. Yeah, go ahead. Derek, is that right? Okay. Uh, 1100 over 1 plus 0.10, right? So you're just discounting back 1 year. Okay, so that's the present value of the first payment. Then you add to that the present value of the second payment, discounted back 2 years at an interest rate of 10%. So 1 plus 0.1 squared, good. And then the same for the third payment, but just discounted back 3 years, very good. So 1 plus 0.10 cubed. Now, that's good enough. That shows to me you understand the concept. If you add all that up, I believe that's 1,000 plus 1,000 plus 1,000. So the present value then would be an even $3,000. Okay? Any questions about that one? Simple enough? What's the present value of a $1,000 discount bond? Can you guys see this okay on the screen? What's the present value of a $1,000 discount bond with 5 years to maturity if the prevailing market interest rate on similar bonds is 6%? In other words, what is the price of this discount bond? The price of a bond is equal to the present value of all future payments to the bearer of the bond. There is only one future payment on a discount bond, and that is the face value. What's the present value of that $1,000 face value payment? It's 1 divided by 1 plus the interest rate raised to the, how many years to maturity? 5. So 1 plus 0.06 raised to the 5th power. You guys remember how to do this? And I believe that would be equal to $746.26. In other words, how do we interpret this right? The absolute maximum that you would be willing to pay for the promise of someone delivering $1,000 to you 5 years from now, given that prevailing market interest rates are 6%, would be $746. You would not pay a penny more than that because you could save that amount. You could, if you had $750, you could save that at 6% and have more than $1,000 5 years from now, right? So the present value of that $1,000 is much less than $1,000 today. It's only $746. How much would you be willing to pay for a 5-year coupon bond with a face value of $1,000 that makes $40 coupon payment at the end of each year? Assume that the interest rate on similar coupon bonds is 2%. Again, we just apply the present value formula. Now, we could do this the brute force way, right? And sum up, what, 6 present value terms? You would get a coupon payment of $40 at the end of every year over the next 5 years, plus the $1,000 face value at maturity. Or alternatively, you guys could use that handy dandy formula that is in your slides, which I'll write down for this particular problem. It was, hopefully you guys can recall where this was in the slides. It would be the coupon payment of $40 in this case, times 1 minus 1 divided by 1 plus 0.02, that's the interest rate, raised to the maturity date of 5 years, divided by the yield to maturity of 2%, plus the present value of the final face value payment. So 1.02 raised to the 5th. And I think if we did that right, it should be $1,094.27. So again, you can choose to use this closed form solution for the present value of a coupon bond, or you could have done what? You could have simply summed up the present value of all 6 future payments. That is 40 divided by 1.02 plus 40 divided by 1.02 squared plus dot, 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 all the way out to 1,000 divided by 1.02 raised to the 5th. Okay, I can't tell if this is like over your head or it's putting you to sleep, or you guys got this? Okay. Let's do a couple more here really quick, since I'm zipping through these pretty quickly here. How about number 4? A $1,000 face value bond has a 10% coupon rate. Its current price is $960, and it's expected to increase. That is, you could sell it in a secondary market to another investor for $980 next year. Can you guys calculate the rate, the holding period rate of return on this bond, or the expected holding period rate of return? If the bond is expected to increase to $980 next year, how do we compute the rate of return? You guys remember how to do that? What's the rate of return? It's the sum of 2 things, really. If you hold an asset and then sell it at some later date, the total return on that asset is the sum of 2 things. It's the coupon payments you receive while holding it, plus what? The net capital gain, right? So in this case, if we were to hold it for just 1 year, then we would get a $100 coupon payment. That's 10% of the face value of 1,000. Plus, what is the capital gain expected to be in this case? The sale price of $980 that's expected next year, minus the original purchase price, which was $960. To calculate the 1-year holding period rate of return, we divide those 2 things by the initial purchase price of the bond, which was $960. And I think that is 0.125 or 12.5%. What's the expected rate of capital gain? How do we get that? I don't really need to ask that, but that's just $20 divided by 960, which is 2.1%, something like that. Okay, questions about that one? Easy? You can expect on your final exam, there's going to be a variety of questions there where you will have to apply your understanding of the present value concept to either price a different type of bond, a coupon bond, a perpetuity, or a discount bond, or alternatively, to figure out the yield to maturity, or at least write the equation that would be consistent with what the yield to maturity would be. Let's do one more. Consider the market for 1-year discount bonds. Quantity, price, demand, supply. Market for 1-year discount bonds with a face value of $1,000. Illustrate and explain what happens to the equilibrium price and quantity of 1-year bonds if new financial regulations, let's say as an example, the Dodd-Frank legislation that passed after the financial crisis, is introduced that make it costlier, so here's the key part, that make it costlier for businesses to quickly sell off large volumes of stock in publicly held corporations. Also explain what happens to the yield to maturity on those 1-year bonds. So what happens to the price and therefore the yield to maturity on bonds if financial regulations make it more difficult to quickly sell off stock? What does that sound like to you? What's going on in this problem? So we want to use the simple supply and demand model of the bond market to think about how this particular legislation would affect prices and most importantly, yields to maturity on bonds. In the last class, we talked about several factors that affect the demand for bonds. I haven't talked about the supply of bonds yet. I'm going to spend at least 10 or 15 minutes talking about that here in a minute, but something happens to the demand for bonds here. Derek? So Derek thinks that the demand for bonds is going to shift to the right, like I've illustrated here, which would, all else equal, increase the quantity of bonds sold or in circulation, and therefore increase the price of bonds. And so, Derek, what then would happen to the yield to maturity on 1-year discount bonds? If their equilibrium price rises, yield to maturities go down. Remember, price and interest rates are inversely related. I think that's correct. Okay, to get full credit here, Derek, you got to explain why. I agree with you, but tell me why bond demand would shift to the right. It is, well, or alternatively, why the demand for stocks shifts to the left. More specifically, Levi? Liquidity, right? If it becomes costlier to sell off quickly, that means the market is not going to be as deep, and so you might incur more transactions costs trying to quickly sell off stocks. Therefore, this is the key part, the relative liquidity of bonds is going to increase, making them more desirable for investors. Pushes the demand out, price up, yields down. Very good. All right, you guys are doing great. Any questions about that? Y'all good? Okay, let me go back to the PC. On the one we just did, it goes, if the equilibrium price rises, yield to maturities fall. Remember, bond prices and interest rates move in opposite direction. Okay, let me try to, as quickly as I can, get through the last few slides in this section. Now, we talked about in the last class several of these factors that affect investors' demand for bonds, and therefore would drive changes in bond prices and interest rates over time. Just to really quickly go through those. Investor wealth, as wealth changes due to changes in the business cycle, the demand for bonds could shift. We talked about expected holding period returns on bonds. We also talked about risk associated with those assets. We talked about liquidity, right? I think those were the only 4, if I'm remembering right. expected return, risk, liquidity, and wealth. Let me spend a few minutes now talking about at least a couple of things that might influence the supply curve for bonds, and therefore also influence price and yield to maturity. Now remember, the supply curve for bonds just traces out the relationship between the quantity of bonds supplied either by investors who already own them in secondary markets or by businesses and governments that are interested in possibly issuing bonds in primary markets in order to borrow, okay? It's that relationship and the price of those bonds, right? Any other change in the economy outside of the price of bonds would cause the supply curve to shift around. What would make businesses and firms who are thinking about issuing new bonds more or less willing to supply them outside of price, okay? There's a lot of factors in our economy. I'm not going to pretend to go over all of them, but I do want to talk about 3 of them as quickly as I can here. The first one is what I'm just going to characterize as changes in general business conditions, all right? And I'll let you guys kind of answer this question here with me. The fact of the matter is that most businesses borrow in order to finance their spending on new capital equipment, machines, factories, warehouses, etc. Okay? And they do that because there are certain tax advantages in the United States to financing investment with debt rather than with equity. Whatever the case may be, what do you imagine happens to businesses' willingness to try to borrow in order to finance their investment spending if business conditions are positive? If the economy is booming and firms expect the profitability of those investment projects to be high, they're more likely going to want to borrow in order to finance investment spending. And so what do you imagine happens then to the supply curve for bonds? All else equal, it's going to shift to the right. And that should put downward pressure on the equilibrium price of bonds and therefore upward pressure on yields to maturity. So when the economy is in an upswing, business conditions are looking positive, firms want to take advantage of that economic landscape in order to try to borrow more to finance these profitable investment opportunities. And they're going to be more willing to borrow, supply more bonds to primary markets, lowering equilibrium prices, and therefore raising yields. Just as a little anecdote here. So in the late 1990s, just to kind of put a real example to this theoretical example in the slides, in the late 1990s and the early 2000s, most retail firms came to view that investing in a website to sell their products online, to increase their online sales and increase their customer base was going to be very profitable, okay? So what we saw happen in the US over the late 90s and in through the 2000s was this huge investment boom in the business sector in things like computers and information technologies and servers and softwares and web pages, etc. A lot of that investment was financed through the issuance of new corporate debt, okay? Pushes the supply of bonds to the right, lowers prices, and raises yields. What do you imagine happens during perhaps a recession? That is, when general business conditions weaken. So if firms are pessimistic about the future profitability of their investment projects, then the supply of bonds is probably going to shift in the opposite direction, right? In that case, equilibrium prices would rise and yields to maturity would fall. So in the last class, we talked about how changes in the business cycle can affect bond prices and interest rates through shifts in demand. Here's a good example where changes in the business cycle can impact bond prices and yields by affecting the supply curve for bonds. A couple more, and I'm not going to show you graphs on this because I think you guys get the story. I think another one is business taxes. So when business taxes are going up or are expected to go up, most firms are going to view that any profits that they might accrue on new investments is going to go down, right? So the higher is, or the less favorable is the tax landscape, the less profitable firms' investment projects are going to look, which means they're probably not going to be as willing to issue bonds in primary markets in order to finance those investment spending. So just like in the last example where a recession pushed the supply curve for bonds to the left, here, if firms kind of generally expect taxes to go up or the tax structure of the economy to be more unfavorable, the supply of bonds is probably going to shift left, raising prices, lowering yields. If, on the other hand, they expect a tax cut, tax landscape looks more favorable, the supply of bonds would probably shift to the right, pushing prices down, raising yields, okay? So taxes, business taxes in particular, are a significant factor in determining the position of the supply of bonds in our economy. Another one I just want to briefly touch on here is government borrowing. Shocker, the United States government has faced large federal budget deficits in recent years, actually for quite a long time. And those budget deficits have gotten even bigger and bigger during the two most recent recessions, okay? Now, how does the United States government finance its budget deficit? And but just to be clear, what is a government budget deficit? That is an excess of government spending over tax revenues. What is the primary way that the US government finances its ballooning deficit? It asks the Treasury Department to issue brand new debt, which is going to be purchased by domestic investors and also probably foreign investors, okay? The explosion in debt is even more relevant during periods where we're experiencing recession. Why is this? During a recession, like the COVID recession, business activity declined. And so the taxes that the government generates are going to go down. At the same time, during recessions, governments oftentimes have to spend more on automatic programs like unemployment insurance. Sometimes they have to provide stimulus packages to the US economy. And so the amount of borrowing, the amount of the issuance of new debt oftentimes goes even higher during recessions, okay? So we see here that government borrowing then would do what? That would increase the supply of bonds into the primary markets and therefore the secondary markets, pushing down prices and raising yields, okay? If the government were to try to shrink its borrowing or, God forbid, pay off some of the debt, then it would have the opposite effect. It would shift the supply of bonds to the left, raise bond prices, and lower yields, all else equal. Okay, so that's just two more examples that you guys can draw with supply and demand graphs. Any questions then about that? No? All right, I want to finish this topic by working through kind of a real world example about how we can use this supply and demand model of the bond market to actually help inform us about something that we see in the data regarding the relationship between interest rates and the state of the economy. That is, whether or not we're in a recession versus an expansion. We know that interest rates on all of these different types of debt instruments change over time. They go up and they go down. Those changes in interest rates ultimately change to shifts in either the demand or the supply curve for bonds. They have to. When bond prices move around because of changes in supply and demand, interest rates change as well. Let's take this basic bond market model to try to help us understand the following observation. I don't know if you guys are aware of this, but during pretty much every past recession that we've had in the United States since at least the mid-70s, interest rates have gone down for the most part during those recessions. Okay, now let me actually, before we illustrate this graphically, let me just show you proof of what I'm talking about. So I don't want you to believe me. Let's take a look at the data. So here is some interest rate data from the St. Louis Fed website. This is the Moody's AAA corporate bond yield. So this is one example of an average of corporate interest rates on corporate debt. Those gray bars there show the recession dates, okay? Now, what do you notice here? That interest rates on corporate debt have gone down during each and every one of these recessions. So here's 81, they fell. During 83, they fell. 91, 2001, they fell a little bit during the Great Financial Crisis and again during the most recent recession. So what we see is this pattern in the data where interest rates, and this is not only true of just of the corporate AAA corporate rated bond, but is also true of a bunch of other interest rates on bonds that you could look up, okay? What I want to try to do for the next couple of minutes is understand why this is happening. And let's try to view this phenomenon, this particular data, through the lens of our simple demand and supply model of the bond market. So here is our initial equilibrium point here at E1, where the price of bonds is just, let's say, P1, and the interest rate is whatever it is, okay? Now, let's suppose that the economy enters into a recession. What do we know happens to the demand curve for bonds in that situation? As economic conditions decline, as employment falls, economic activity goes down, people's wealth falls, and that's likely to do what? To cause the demand for, I don't know why this isn't, cause the demand curve for bonds to shift to the left, right? This is an example that we took from the last class, which would tend to do what? Put downward pressure on price and cause yields to rise. Well, what do we see in the data? Interest rates are actually going down during recessions, not up. So this must be an incomplete story of what's going on. What do you think is happening here? During recessions, Levi, something's probably happening to supply, right? Well, we also know that during recessions, when business conditions are declining, that the supply of bonds might be shifting to the left, which would put upward pressure on prices and lower yield, okay? So the model itself kind of gives an ambiguous answer to whether or not cyclical downturns in the economy would tend to raise or lower interest rates. But what we can do is we can take the model and align it with the data to say, well, look, in order for the model to be able to explain what we actually see in the data, which is a fact that interest rates tend to decline during recessions, it must be that the supply is shifting by more than the demand, right? So that the net effect on price is positive, and therefore, on balance, the interest rate is going to fall. In other words, one might conclude from this that the cyclical sensitivity of supply is somewhat greater than the sensitivity of demand. Okay, so that's how you can take this very straightforward supply and demand model of the bond market to try to provide a little bit of insight on what must be happening during recession regarding interest rates, bond prices, and overall economic conditions. Okay, you guys have any last questions about that before we move on to the next topic? Good, because I don't have enough time to answer them. All right.